Welcome to the GIC College of Central Bankers Conversation Series. I'm Kathleen Stephansen, and I'm the Vice Chair of the college. And today we will explore the theme of monetary policy, and more specifically, what is the neutral policy rate? So we are joined by Jeffrey Lacker, Professor of Economics at the Virginia Commonwealth University School of Business in Richmond, Virginia. He joined the faculty of the VCU Business School after serving more than 12 years as president and CEO of the Federal Reserve Bank of Richmond from August of 2014 to 2017. And in that role, he participated in meetings of the Federal Open Market Committee, which is the policy arm of the Federal Reserve, and served for rotation as a voting member. So he's very qualified to talk about the neutral rate here for today. Jeffrey, thank you and welcome to this conversation. So let's dig in right away. We know that the Fed has raised the federal funds rate by slightly more than 500 basis points from, early to 2022 to the current 5.33% to be quite accurate. In your mind, what is the estimated long-term Fed funds rate in terms of a neutral Fed funds rate, which means no inflationary pressure and steady growth?
It's a really good question. I think 3.5 is a good central tendency of an estimate of the long range of what the neutral rate will settle to in the long run. But using that as a gauge to policy is a little tricky. If I could elaborate on that a little bit for a minute. First of all, thank you very much for inviting me, Kathleen. It's a real pleasure. Been an admirer and engaged with the Global Interdepende Center for decades, and really appreciate what they do. So the neutral rate is not an observed magnitude. It's a latent variable. I had an econometrics professor at the University of Wisconsin, the late and great Art Goldberger, used to say that there's nothing that gets an economist quite as excited as a latent variable. So because it's a latent variable, you need some theory to extract it from the data. And the approach that economists have settled on taking, the reason in which this latent variable emerges is so important is that we have a kind of a set of models, a sort of a standard framework for the last 25 years about how economies behave relevant, in a way that's relevant to monetary policy. And this latent variable emerges from taking a model that's supposed to describe the economy reasonably well for purposes of monetary policy analysis, and then looking at a parallel universe in which that model describes reality, but the model isn't subject to monetary frictions. So it doesn't have the price stickiness that we think is important in the real world. And so in that parallel universe, there's a real interest rate, the interest rate adjusted for expected inflation in the short run. And that's the neutral rate in an equilibrium of that model in which markets clear, supply equals demand, and these monetary frictions are absent. And inflation notably is stable at a central bank target. You get a real interest that cranks out a real interest rate. Now, that real interest rate will respond to productivity shocks, fiscal policy shocks, resource constraints, all sorts of developments, short-run developments that can fluctuate over time, pandemics, the like. So there's a real interest rate in that parallel universe that fluctuates and call that R star, call that short run R star. As you run that parallel universe into the future and assume that there aren't any more shocks from now on, after all, they're shocks, because they're shocks, we can't anticipate them. We don't know what they're going to be. So assume that, those shocks sort of die out over time. What it gets to in the long run, that's the long run R star, the long run neutral rate. But the rate that's relevant for policy really is the rate of R star today, the short run R star. And that's the rate that the Fed needs to track, needs to shadow, sort of follow over time as best it can in order to keep inflation on, at its target, reasonably close to its target. And that's the kind of the basic framework for how R star, how I think about R star and how I think most economists that study this think about R star.
Yeah. So before I'd like to dig into what you just said, but I am a tad surprised maybe of the fact that you think that the neutral rate is has a 3% handle. There's been a lot of talk.
Maybe I should clarify. So that's with an inflation target of 2%. That's a nominal. That's a target for the nominal neutral rate. Okay, so I'm thinking between 1% and 2% is what the real rate. Now, there are a couple of empirical estimates out there. There's two leading candidates. One of them is from the Federal Reserve Bank of two economists at the Federal Reserve Bank of Richmond. At least one's there now, and one used to be. That's the Lubick-Mathis estimate, and that estimate is around 2% now. There's another estimate from Thomas Laubach and John Williams and another co-author I can't remember the name of, that is about 1.25. So those are in real terms where I think I'd put R star. And then
that's important.
2% inflation target. So I was imprecise.
So, I guess that these fairly low estimates in real terms take into account, obviously, that potential growth has decelerated quite a bit over the past decades or so. Would you agree with that?
Yeah, I think that's I think that's the fact that most economists would point to explain the secular decline in estimates of R star from in the range of 3 or 4% several decades ago to estimates that reached under 1% in the 2010s and are now between like 1.25% and 2%, as I said.
Right. And so the question is, will you espouse to a specific model in terms of trying to estimate? Because clearly we do see different models. You just mentioned two, implicitly two of them, which and I'm thinking more in terms of the framework of reaction function, and we know that has changed over time. And to what extent, if the Fed decides, quote unquote, to change its reaction function, how transparent should it be in terms of explaining this to market participants, particularly?
Yeah, that's a good question. So the Fed achieved a measure of price stability beginning in the mid 1990s and kept up until 2021, kept inflation very stable around 2%. So underlying that was an implicit reaction function, one that the Fed tended to follow and that markets understood that the Fed would tend to follow, but there was some fuzziness about it. There was always a little bit of uncertainty. There was always a little bit of hesitance. There was, a reservation you'd have to make about whether, the Fed would follow through on that. And just what that meant in terms of any individual profile of the economic data over the next year or so was always something the Fed was hesitant to speak very clearly about, hesitant to put itself on the hook or commit to. And that's something that has gotten a lot of debate. I think a lot of economists, all economists would endorse the idea that the better the public understands, the better policy will be. They won't be confused about things. They'll be able to make better decisions if the Fed can eliminate as much uncertainty as it can. But I think that, counterposed to that is just an institutional motivation, I'd call it, to preserve optionality. And I think this is something that's very attractive in central banks, something central banks are drawn to, but I think to their detriment in the long run. I think it's something that central banks have trouble overcoming, the desire to just preserve the discretion to react in some unanticipated way to data as it comes in. So I think that in my mind, the reaction functions embodied in Taylor rules are the natural benchmark for central banks. And I think that central bankers all subscribe to the idea that it's a great reference point. I think central bankers could make better use of the Taylor rule or various estimates of the Taylor rule to describe how data and to explain to people how they're likely to react over the next year or two to incoming data that might be different from what people expect.
Well, but that's interesting because, the Taylor rule was definitely the general framework when you did have inflationary pressures. But, as you saw inflation really decelerating to the point that, you almost were fearing disinflation and deflation, it had very little positive meaning, if you will, to the and I think that's when you've had a forward guidance and now data dependency. And in fact, which one of those two would fit the bill, if you will, because now we hear Chair Powell talking about data dependency much more than the forward guidance. So it's interesting to see that over the past 10 years, there's been a clear shift here. And when is it that shift should, again, find another type of framework?
Yeah. So the Taylor rules, obviously run into this issue when they predict or they recommend central bank policy rates well below zero. This happened in the early 2010s after the great financial crisis in 2008 and 2009. At that point, the central bank is kind of stuck. It can't do what the Taylor rule says. So it's kind of like a Taylor rule needs a little amendment, unless this says go way below zero, here's what you should do. Now, the situation we're in now is very different. Back then, when you got below zero, the central banks tried forward guidance to try and push down the longer end of the yield curve to convince people they'd be lower for longer. But the attempts to do that were somewhat imperfect. So, for example, at the Federal Reserve, the forward guidance was about how long they thought interest rates would be at zero. But they very specifically worded this as not a commitment to do something that they otherwise might not want to do, but they worded it as a prediction of what they were going in the future want to do. So a very, very different
talk about being transparent
of forward guidance. So it's being transparent, but it's saying, well, no, you're wrong about what you're forecasting we're going to want to do, but we're not going to commit to do anything. We're just going to do what we want to do then. And so it's not clear that the way they worded it was worded in a way to have much power, if or
Well, it
much.
creates, these double negatives create a lot of confusion,
Yeah,
to be honest.
that too. But now, the current problem is on the opposite side, and it's kind of the problem that Taylor rules were sort of ideally suited to,
Right.
react to.
Well, that begs the question, to what extent, if you were to apply a Taylor rule, is the Fed done at current Fed funds rate, or
It's really good. That's a really good question. So I'm, on the Shadow Open Market Committee.
Yeah.
And I wrote a paper for them with Charles Plosser, my former colleague at the Philadelphia Fed, another GIC College of Central Banker member. We started arguing like late 2021, 2022, that the Fed the Taylor rule showed just how far behind the Fed got, just how far behind the curve they were. The Taylor rule was recommending in the middle of 2021, recommending that the Fed raise the funds rate. And in September, October, it was saying the funds rate, should be, above 2. And in 2022, when they raised rates, it said the Fed funds rate should be, pretty high, like 6 or 7. And in late last year and beginning of this year, it was still saying the Fed funds rate should be fairly high. Now, inflation's tailed off. The Fed didn't do that much tightening, but the Fed's, to its credit, it's gotten inflation down a fair amount. And right now, the Fed policy rate is in line with the recommendations of Taylor rules, of the standard Taylor rules that are adopted. So by that measure, it's doing pretty well. Now, the qualification to that has to do with R star, because, to circle back to the beginning of our conversation, Taylor rules have R star in it. And so the question is it long run R star? Is it short run R star? And the empirical estimates I told you about were kind of the trend in R star. It's sort of like what the current estimate of the long run R star is, but that's shifted. It's not a constant. And as that came down, people reduced their estimates of R star in that they used in the Taylor rules. But it's been rising again since over the last 10 years. And, whether the Fed's tightened enough kind of depends on the stand you take about R star. So if R star's crept up, if it's at 2%, maybe the Fed hasn't done enough yet. So a couple of questions here. First, I'm surprised that you say the Fed hasn't done enough yet. But the other question is, taking the Taylor rule in a very dogmatic way back in 2021, early 22, and, realizing that, okay, the Fed is behind the curve, doesn't take into account, number one, the fact that we were not really out of the pandemic yet. You still had one wave. Was it the Delta or the Omicron? This is where my Greek alphabet gets a little hazy. I get those waves mixed up.
Yeah, right. And so that's number one. Number two, the fact that you really didn't. It couldn't take into account the supply issues that brought about some inflationary pressures. And the question is, does that matter or not?
Yeah, that's a really good question. And a lot of the media coverage in the financial press has been really confused about the macroeconomics of this. So there's this famous quote from, and I can't remember the exact quote. I should look it up, from Alfred Marshall, that it's the great English economist from the late 1800s, who said that it's asking whether it's demand or supply is like asking which blade of the scissors cuts the paper. And the application here is, well, demand surged in 2021 for goods and services of various types. Maybe the composition has shifted since 2020, 2019, but demand surge, overall demand surged. And what would you expect from that? Well, you would expect some industries with relatively elastic supply curves to experience little price pressures. And you expect some industries to have very inelastic supply curves. And you're going to find out which ones have inelastic supply curves and which have inelastic supply curves. So from that point of view, it's just inflation is simply a matter of the balance of supply and demand. And whether it's there's always going to be some that are there's more pressure than others. And there's always going to be some pressure somewhere. And so it's whether supply went down in the face of fixed demand, or demand went up in the face of fixed inelastic supply. Either way, you get inflation. And either way, the right remedy is you want to try and persuade people to wait, to delay spending. And the way to do that is to raise the real interest rate. Because if you don't get them to wait, prices are just going to go up and you're going to have inflation. And that's kind of the logic behind, the Fed needed to raise rates, even if, pandemic considerations had altered supply conditions. In fact, especially if they had. I mean, if we don't have much supply, you got to get people to wait. And we were giving people a lot of money, but we weren't doing anything. The Fed didn't do anything to encourage them to wait until supply was there.
So then you fast forward and, you had kind of a catch up. The Fed, as we all saw, was fairly aggressive in raising interest rates. But what kind of delayed maybe the reaction of the macroeconomic environment is the fact that long-term interest rates remained, fairly low. And it's only, one can argue, recently that you see the increase or the rising trend in long-term interest rates. And to what extent this is enough now to call, the situation really tightened. This is, the financial conditions now are tight enough that, we can either delay or even prevent. But it seems as though you're not sold on the preventing further rate hikes.
That was a good question. I was surprised in October to hear some of my former colleagues at the Fed talk about the rise in long-term interest rates, which started in mid-July or so and went up 100 basis points, pretty strong move in a short amount of time. I was surprised to hear them say that maybe it did our work for us, because there's a lot of different interpretations you could make, you could advance for them. One of them is that the supply of Treasury securities was ramping up, and this was, of course, consistent with our fiscal imbalances in the United States, which are large and growing. And so maybe that's going to push, maybe just the fiscal borrowing is going to push up real interest rates. Well, if that's true, that's pushing up our star, and that's something the Fed has to track. And if that's why long rates are going up, the Fed has to track that and tighten even further. And this, in fact, is a dynamic that was very important in the 1980s and early 1990s, when the Fed was getting its hands on inflation. And the Fed looked to the long rate as a signal of whether inflation expectations were rising. And so it had to react and nip those in the bud. And those preemptive actions were really critical to getting price stability.
But, it's when you look at economic conditions, I mean, to be honest, it's not that surprising to see the rise in long-term rates. I mean, Q3 GDP will have the next estimate on Wednesday, but now it's not even coming down. people are looking for 5% handle as opposed to the 4.9, you know. I mean, that in and of itself should explain the reason why in fact, why aren't long-term interest rates higher?
Yeah, no, I agree. And, you know, it raises the question of whether the Fed's done enough. I mean,
Right.
doing enough means delay, you know, kind of delaying spending enough, getting people to slow spending growth. And yeah, the third quarter number is something I think has to give the Fed concern. Now that they're acting as if it's transitory and that the real growth will slow in the next couple of quarters. Of course, they've been saying that for a couple of quarters, but you know, they're thinking it's going to slow enough in the next couple of quarters that they can stand pat where they are for a few meetings. But
that's you know, when you look at going back to in January, I mean, everybody in as a practitioner in economics was looking for a recession this year. So if anything, growth has surprised on the upside. And what I find quite amazing is that the interest rate sensitive sectors, well, they have reacted, housing has reacted, but not to the extent that one would have anticipated given the rise in interest rates. And that to me, you know, begs the question as to whether we've had some structural changes here that are such that there is not enough of a reaction to the monetary policy, you know, framework. I'm thinking the unemployment rate, for example, labor market. One can argue that it's not as tight as the number the unemployment rate tells you, but even so. And spending, look at spending.
Yeah, I agree. The housing market's really peculiar. It's very different than the, you know, 70s and 80s and 90s cycles. And I think it's because the extended period of low interest rates with everyone refinancing locked a lot of people into really low rate mortgages and has reduced the turnover of housing. People don't want to move. They're kind of locked in, and that's diverted what demand there is, even at higher interest rates, into the construction market. So I think it's a really different reaction of the housing market. And so as a result, I don't think they're going to get as much bang for their tightening buck out of the housing market as they used to, which means they've got to get more bang from some other sectors. You know, we're seeing
unless inflation comes down more quickly.
Right.
And for reasons, again, that are, you know, maybe not entirely due to the tightening that we've seen.
Yeah, no, I think the open question is whether the Fed's done enough at you know, 5.5, 5.25 to 5.5. And I think that's a legitimate question. So they've gotten a string of four or five good, decent inflation numbers, you know, with one or two, like the last October month, wasn't that great? But that's given people a lot of cheer. But if you look at the wage numbers, they're still not down to, the wage growth numbers are still not down to the level that would be consistent with 2% inflation. And unless that happens, they're going to exert this gravitational pull that's going to bring inflation numbers up in the next couple of months. So that's the kind of the open question of whether the kind of the underlying trend that it's going to gravitate to in the next few quarters is really closer to 2 or closer to 4. Kind of looks like 3.5 or 4 to me, but we'll see how that goes.
Yeah. I mean, it is interesting because now that you are seeing signs of inflation coming down, there is almost like a sigh of relief, certainly in the market we've seen. But in a way, the situation is still extremely complex. And, you know, one issue is, do you believe that, okay, the call for recession is just simply, you know, delayed? It's not happening today, but down the road it will. The other things are the external events. For example, the whole situation in the Middle East, is this likely to spur bigger hike in oil prices? I don't know what your thoughts are about that, but, you know, it's still an open question.
Yeah, I would agree with the notion that the trajectory the Fed's on is still fraught with many risks. I think that there are the potential for inflationary shocks that feed through and into headline inflation and drive further wage increases and further catch-up price increases elsewhere in the economy that would make the Fed's life kind of difficult next year. I think that there's a risk that labor market cools and keeps cooling more and tips over into a more rapid deterioration. There's a kind of a non-linearity if you look at the data, where if the unemployment rate rises by a certain amount, it always rises by a lot, it seems, historically. The Fed's trying to avoid that. It's kind of tiptoeing as if it's on the edge of a cliff. But if it doesn't get inflation down, and inflation stays around 3.5% or 4%, they're going to be challenged next year, and they're going to feel like they have to do more to get inflation under control. So, and I believe them when they say that they're willing to risk a recession if they have to do that, but they're trying to get away without it, and it remains to be seen whether that's feasible or not.
But so this, what I find complicated in the assessment of the Fed's policy, being data dependent now, is that essentially we don't know what the leads and lags are anymore. And, presumably what we've seen up until now seems to indicate that these lags are getting longer for reasons that are, a variety of reasons. Which means that the idea of pricing in by markets that the Fed is done and what will be the next move, a rate cut, when do you think the rate cut will take place? And you see that in the consensus, people are, pricing in a rate cut mid next year.
Yeah, it's crazy. I think it's a little premature to be talking about rate cuts if they don't have inflation down. You can see the Fed very concerned about those expectations about rate cuts, and they're doing everything they can to keep potential for rate increases on the table and to resist saying anything about rate cuts. And I think they're going to continue doing that until they're convinced inflation is, on a persistent and sustainable basis down under 2.5, say.
Right. And, to circle back to the early part of the conversation, what this tells you, though, is that the R star keeps on moving.
It does. And finding that's the golden, that's the holy grail in central banking. Something you're trying to shadow. If market forces push it higher, you got to go up with it. And if market forces push it lower, you got to go lower with it. So, that's the trick.
So I have a question, that is, a little bit different from what we've been speaking up until now. And that is with regard to the dollar and the dollar peg in particular. We've seen the events, the shift in administration in Argentina, for example, and the new incoming government mentioning that they would like to adopt a peg, the dollar peg. We've seen that in the past. It hasn't really worked over the longer run. What are your thoughts about it?
It's a really interesting question. It seems, they're talking about dollarizing, getting rid of the peso, getting rid of the central bank and all. And you got to admire that that could work. But the only way it's going to work is with a commitment to fiscal balance, a commitment to run fiscal policy that makes dollarization sustainable. And until they have a credible fiscal reform of their fiscal regime, it's like putting the cart before the horse to get rid of the peso. Because, if they don't do that, they're going to be tempted to confiscate, dollars that are in the banking system. They did it before. So
that's right.
The key problem is the credibility of their fiscal their fiscal regime. And that's the thing they need to think about. And I think my understanding is he's sort of he hasn't talked about it since the election, since he won. He hasn't talked so much about dollarization. So maybe they've realized they need to go slow on that until they put their fiscal house in order.
I guess we shall see how it evolves.
That'll be really
Yeah, yeah. Jeff, thank you so very much for taking the
My
time to
pleasure.
speak with us. And I just like to, end maybe our conversation with a thought. Usually people tend to ask what keeps you up at night, but perhaps, let's be a little bit more optimistic. And in your mind, what are the most positive features of the current outlook?
Oh dear. So I'm tempted to mention my grandchildren that visited me last weekend for Thanksgiving. But
Oh, they are probably the best.
yes, 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 and they give me much hope and optimism for the future. But more to the point here on the economic policy scene, I think the recent talk I've heard in Washington of a bipartisan commission on fiscal policy is a very positive development. These come up every generation or so, and every decade or two, and sometimes they work, sometimes they don't. But the fiscal outlook for the United States is quite seriously skewed and poses a grave threat to monetary policy over the next 5 or 10 years. And if a bipartisan effort truly emerged in Washington, that would be a signal of a reasonable amount of good hope.
Well, you are, I guess, in Richmond. Hopefully, you didn't have to speak that loud. People will hear you in Washington.
Well, I'll do my part if
Right.
anyone thinks that would be productive.
Thank you so very much. And hopefully we can
Thank you.
continue this conversation in the future when things have changed, happened, or whatever. We'll take
revisit
a new shot. Yes.
Thank you very much, Kathleen. I've
Thank you,
really
Jeff.
enjoyed this. Great talking to you.
Likewise. Bye-bye.
Bye-bye.